Business quality and moat what they do. Business model brand house collective BHC is a multi-brand merchandising, supply chain, and retail operator in the home and family goods sector. It owns and operates Kirkland's Home and is in the process of rebranding many stores to Bed Bath & Beyond Home. The company is also exploring physical retail locations for retail overstock and leveraging wholesale channels for its brands. Recently, it sold the intellectual property rights for Kirkland's Home to Bed Bath & Beyond for about $10 million. Competitive advantages / moat potential. Buffett always asks, does the company have a moat? Here's how BHC stacks up. Moat factor, strength, weakness. Brand heritage. Kirkland's Home has approximately 60 years of brand recognition. Brand heritage alone hasn't prevented financial decline. Customers could shift to cheaper or trendier alternatives. Scale footprint, 300+ stores across 35 states, though consolidating to approximately 290. Large scale brings heavy fixed costs. In-store traffic is declining due to e-commerce competition. Partnerships, licensing ties with Beyond Inc., Bed Bath & Beyond Home. Overstock, buybuy BABY offer co-branding and conversion opportunities. Dependence on licensing IP agreements could add costs and reduce margins. Operations, supply chain actively working on inventory optimization, store consolidation, and cost controls. Results not yet proven. Gross margins and e-commerce performance remain under pressure. Conclusion on moat. The moat is currently weak. Heritage, scale, and partnerships provide potential, but execution risk is high and nothing is yet durable. Management quality, leadership credibility. CEO Amy Sullivan has brought in a new CFO, Andrea Courtois, and fresh supply chain and merchandising leadership. The team is signaling an operational reset, store closures, conversions, inventory management, showing awareness of problems and willingness to act. Capital allocation skill. Selling Kirkland's IP for $10 million provided cash, but reduced brand ownership. Expanded credit facility $2 to fund conversions. Closing underperforming stores shows discipline, but success depends on execution without destroying value. Shareholder alignment, no dividend payments. Company is currently loss-making. Share dilution through Beyond's ownership. Management seems candid about risks, but the turnaround strategy is still speculative. Financial strength. Revenue declining. $1 for 2OM TTM versus $441 million prior year. Margins. Gross margin down to approximately 16.3% from approximately 20.5%. Operating margin negative. Returns. Negative ROE in ROIC. Debt. High liabilities. Negative equity in some quarters. Free cash flow. Negative. Buffett would wave a big red flag here. Intrinsic value. Valuing BHC is difficult because the company is currently losing money. A turnaround scenario, if margins rebound, free cash flow turns positive. $1 for OM within 5 years, and growth stabilizes. Good. Justify a valuation in the few hundred million range. But today, with shrinking sales, negative cash flow, and heavy debt, intrinsic value is highly uncertain. Long-term prospects. Industry outlook. Home retail faces strong e-commerce pressure, inflation, and weak discretionary spending. Still, demand for home goods exists, especially when tied to brand and in-store experience. Risks. Execution risk on conversions. Liquidity risk. Going concern. Issues flagged. Competitive pressure from giants like Walmart, Amazon, Wayfair. Margin pressure from costs and weak e-commerce performance. Can they compound capital for 10+ years? It's possible only if the turnaround succeeds, not the company risks further decline. Final verdict. Buffett-Style. Understandable business. Yes. Consistent earnings. No losses and revenue decline. Good ROIC. No. Both negative. Low debt. No liabilities are heavy. Attractive valuation. Possibly, but high risk. Durable moat. Weak and unproven. Bottom line, BHC doesn't fit Buffett-Style right now. It could be a turnaround play, but Buffett prefers businesses with proven moats, consistent profits, and strong financials.